This is Dave. He's 40, healthy, and doesn't smoke. Dave has two ways to protect his family, and they cost wildly different amounts. Term life, $59 a month. Whole life, $574. Same guy, same $500,000 payout, nearly 10 times the price. So which one actually leaves Dave richer? Let's break it down. Quick note before the numbers. This is decision math, not advice. Rates vary by state, health, and year. Start with the incentive. The person explaining these policies to you usually earns a commission. On whole life, that first-year commission can equal a very large share of your first-year premium. On term, it is a small fraction of a much smaller premium. So one product pays the seller many times more than the other. That does not make anyone a villain. It just means the advice you hear is rarely neutral. I do not sell either one, and no affiliate link changes a single number in this video. I am going to put both quotes on screen and run the math. Both products are legitimate. One is simply pushed far harder than the numbers justify. Here's the number that holds the whole story. For the same death benefit, whole life costs roughly 10 times what term costs. Depending on the carrier and your health, the range runs from about 8 times to more than 20. That is not a rounding error. That is the difference between a small monthly bill and a second car payment. So let me show you the actual quotes behind it. Same buyer in both columns. Remember Dave, 40, healthy, a non-smoker with $500,000 of coverage. The 20-year term policy is about $59 a month. The whole life policy for the exact same payout is about $574. Over the 20 years, term costs you around $14,000 total. Whole life costs about $138,000. And here's the part the brochure rarely highlights. Your term premium stops after 20 years. Whole life premiums keep going, often for decades more. So the real lifetime gap is even wider than this table shows. Line the two up and the difference is $515 a month. That is $6,180 a year and more than $123,000 across the 20-year term. Same $500,000 payout on both sides. You are paying 6 figures extra for something. So what is the something? Whole life does include one thing term does not, a savings account called cash value. That is the entire justification for the price. So let us open it up because this is where the pitch lives and where the math gets interesting. In a minute, I will show you what that cash value actually earns in the years that matter most. The answer is worse than most buyers expect. A whole life premium does 3 jobs at once. It pays for the death benefit like term does. It covers the insurer's costs and the seller's commission, and whatever is left builds your cash value. The pitch focuses on that third bucket. Your money grows inside it, tax-deferred, and you can borrow against it later. All true. The question the pitch skips is simple. In the years you are actually paying, how much of your money reaches that savings bucket? And how fast does it grow? Here is the answer for year 1. Roughly 50 to 80% of your first-year premium goes to commissions and fees, not into your cash value. Put that against the table you just saw. You pay in around $6,888 that first year. A large chunk of it is gone before your savings bucket sees a cent. On many policies, the year 1 cash value is close to 0. That is not fraud. It is just how the product is engineered, and it is why the early years feel like they go nowhere. And to be clear, these are not my numbers. They come straight from the industry's own breakdowns of how these policies are built. Because of that front-loading, it commonly takes 10 to 15 years for your cash value to simply catch up to the premiums you have handed over. Surrender the policy in the early years, and you can walk away with less than you paid in. So for the first decade, this is not a savings account that is quietly winning. It is one that is quietly behind. And when it finally does grow, look at the rate it grows at. The guaranteed cash value growth is usually 1 to 3.5% a year. A basic stock index fund has historically returned around 7 to 10%. So the savings account inside the policy is real, but it is slow, and it is wrapped in a decade of fees before it even gets going. Hold that thought because it sets up the comparison this entire debate turns on. One more piece of the pitch deserves a straight answer. Yes, you can borrow against that cash value. But read how it works. You are borrowing your own money, and the insurer charges you interest to do it. Any loan you do not pay back is quietly subtracted from the death benefit your family receives. So the flexibility is genuine, But it is not free money, and it can shrink the very payout you bought the policy for. Useful in a pinch, not the personal bank it is sold as. So here is the alternative, and it has a name. Buy term, invest the difference. You buy the cheap term policy for the same $500,000 in coverage. Then you take the $515 a month you did not spend on whole life, and you invest it yourself in something simple like a low-cost index fund. You keep the insurance and the savings in two separate places, each doing its one job well. Let us run the numbers on that. $515 a month, invested for 20 years at a 7% annual return, grows to roughly $268,000. That is money you own outright, completely separate from the insurance. Now, one honest objection. People say term is a waste because you outlive it and get nothing back. But look at what you actually have here. You had a full $500,000 in coverage for 20 years, and you built a $268,000 pot on the side. That is not nothing. That is the whole point. Now, the fair objection in the other direction. That $268,000 is not guaranteed. Markets rise and fall, and 7% is a historical average, not a promise. Whole life's small return, by contrast, is contractually guaranteed. That guarantee has real value if you truly cannot tolerate any risk. But over a 20-year horizon, a broad index fund has been remarkably reliable. So the honest framing is not guaranteed versus risky. It is a low guaranteed return against a higher likely one. Which brings us to the rule that actually settles it. If the money you invest earns more than about 4% a year, buy term and invest wins. Earn less than 4%, and whole life's guaranteed floor starts to look better. Over the long run, a diversified index fund has cleared that 4% bar with plenty of room. The one honest advantage whole life keeps is discipline. It forces you to save. If you know you would spend that $515 instead of investing it, that is a genuine point in its favor. But it is a very expensive way to buy self-control. Now, I promised you the flip, and it is real. There is a specific buyer for whom nearly everything I just said reverses. If that is you, the cheap answer is the wrong one. It comes down to one word: permanent. Term has an expiration date, and that is the entire point of it. It covers a temporary need, a mortgage, the years your children are dependent, the stretch until your retirement savings can carry the family on their own. Those needs end, and the policy ends with them, and that is fine. But some needs never end, and when the need is permanent, term will expire while the obligation is still standing. That is where whole life stops being a markup and starts being the right tool. Whole life earns its price in three situations. First, and clearest, a dependent who will need financial support for their whole life, a child with a disability, for example. That need does not expire at 65, so the coverage should not either. Term would lapse while the need is still there. Permanent coverage will not. Second, an estate large enough to trigger estate tax, where a permanent policy funds that bill efficiently and predictably. Third, a high earner who has already maxed every retirement account and wants more tax-deferred room. Notice the pattern. The need is permanent, and the buyer is not using the policy as their main savings plan. One honest footnote. Even for a permanent need, whole life is not the only permanent option. Guaranteed universal life can cover you for life at a far lower price because it skips most of the cash value. So a permanent need does not automatically mean whole life. It means match the length of the coverage to the length of the need. So here's the honest call. It depends, but not on a coin flip. For the large majority of buyers, with a mortgage, young kids, and a normal-sized estate, term is the answer. Same payout, a small fraction of the price, and you invest the difference. Whole life is the right choice for a narrow group with a permanent need. A lifelong dependent, an estate tax bill, or a maxed-out high earner. If you are in that group, the premium is buying something real. If you are not, that 10 times price is buying mostly commission. Take Dave, our healthy 40-year-old. For him, term means the same $500,000 payout, and about $268,000 more in his pocket over 20 years. Whole life is not a scam. It is a specialized tool sold to far more people than it actually fits. Know which group you are in before you sign anything. Once you know which type you need, the next question is how much. I ran that number against a real household budget with no lazy rules of thumb. It is right here, and every number is sourced. I will see you in that one.